Welcome to our webinar, Trading Commodity Spreads in Volatile Markets. I'm Betty Smith. I'm Vice President of Communications here at CQG. And our guest speaker today is Michael Martin. Welcome, Mike.
Hey, thank you for having me, Betty.
So we're very excited about our webinar. And we're going to jump right to Mike's bio. And as you can see, Michael's been trading for over 20 years. And he has kind of the complete package. He's a trader, he's an author, he blogs at martinchronicle.com, and he's also an instructor. And Michael shares some of his trading experiences in his new book, The Inner Voice of Trading. So welcome again, Michael, and with that, I'm going to pass it off to you.
Well, thanks again, and thank you for putting this together. It's exciting. I think spreads are a very undercovered area of commodity futures. They seem, for professional traders anyway, they seem to be a way of life almost, especially if people have started their career on the floor, you know, buying the Julys and then laying off the risk in December, for example, are a way for market makers and locals to manage their risk when they're filling orders very, very quickly. In the equity space, it's not so prevalent because there's only one type of Microsoft stock, for example. And although you can create synthetic positions with, you know, long stock and long a married put, for example, or maybe even try to trade single stock futures, the dynamics of inter and intra commodity spreads are very, very different. So today should be very eye-opening for folks who have not come across this very valuable segment of commodity futures trading. Coincidentally, not to plug CQG too much, your technology is really, really good for people who want to follow spreads. So the good news is that this is going to largely be a homegrown audience. They already have the technology in front of them, as we shall see, to really see some great spreads through their technology already. So let's look at some spread facts. A spread is really a mathematical difference, you know, where you're subtracting one number from another, and that, in fact, becomes the security that you're looking at. So it's the relationship between two contracts that you are simultaneously long and short in the same portfolio. Later, we're going to learn that you have those on at the same time and you put them on at the same time, because the whole point of spreading is to also take advantage of lower risk. And why do you have lower risk? Well, because you're long and short the same commodity, albeit through different commodity month expirations, you are therefore considered hedged, because corn is very correlated to corn. Not to sound like a Dr. Seuss truism, the July contract, for example, will be very correlated to the December contract, although the needs and the wants and the production supply to the market may be very, very different over the calendar year. Those contracts are nonetheless correlated. So by being long one and short the other, you are hedged in your portfolio. And because of that, the Chicago Mercantile Exchange affords you much lower margin. I say CME because I think of Chicago Mercantile Exchange. It's really the CME group now that does all the calculations for the commodities. They are set by the exchanges, and your FCM, whether you're going directly through an FCM or an IB, can always make those margins more stringent, but they cannot make them more lax. So the margin is lower because there are several directional ways the thing can play out. You have 5 or 6 different ways to win, and because these tend to be out on the calendar strip, as they say, you give them, you give the spread a lot of time to work out. So time is on your side. How do they calculate the margin real quick? Well, you're looking at a drastic haircut to normal margin, whereby, you know, outright margin for crude oil might be, say, $10,000, but by trading the Brent WTI spread, you're giving a whopping 65% discount to that outright margin. We'll talk about that later on in terms of risk management, whereas you don't want to all of a sudden find all this extra money that's not committed to margin. You don't want to lever that up and actually trade bigger, because that's typically a no-no. You typically trade one spread for every outright contract you would normally trade. Now, the CME group looks at change in daily prices going back 4 years, and then they calculate something known as value at risk to both 95 and 99% confidence levels to see what the worst case scenario would be, and then they price the margin off of that. They also take into account the notional value. Notional value would be, say for example, COMEX gold trading at, off the top of my head, $1,700 per ounce. It's a 100-ounce contract, so you're looking at $170,000 of notional value. And you can do that for every contract out there. They look at some other, I don't want to call them esoteric things, but they do look at some things that are a little bit more subjective, like they look at the bid-ask spread. They look at carry charges. They might consider hurricane season for commodities where that would be an issue. They would also look at volume and open interest. And that would help them determine what the margin levels are, all for your protection, right? The margin is not like equity margin under Regulation T in the stocks and ETF space or what have you. This is more about, it's a bit of a misnomer. Margin is really a good faith deposit on the full notional value of the contract. Now, today we're going to discuss a few things about spreads. It's not meant to be rocket science, and it's not meant to be a thorough discussion, in as much that spreads are they're easy to understand, but they can get very, very complicated. Why? Well, because you're really talking about fundamental trades now. Yes, you can trade off technicals, but you really need to understand the nuances of the crop year in corn or soybeans, for example, or the seasonality for cocoa or coffee. If you're going to try to trade these spreads, they have to make sense. There has to be a relationship. So, for example, with your CQG, you could probably sit down and type in a spread to show a relationship between corn and copper, but there is no real relationship between corn and copper. And if you see something, it's likely like looking up at the clouds and finding a pattern. So we're going to talk about bona fide spreads, both inter and intra commodity spreads. The inter-commodity spread would be a relationship between two different commodities, such as light sweet crude, the West Texas Intermediate that trades in NYMEX, and then the Brent C is a different type of crude oil. It's a higher sulfur content. We could talk about wheat versus soybeans, for example, which they're both grains, but they're different commodities. We'll look at that. Whereas an intra-commodity spread is within the same commodity itself. So an old crop, new crop spread. That would be like corn versus corn, July corn, December corn, July beans versus November beans. We'll also talk about risk management. If you're afforded lower margin and you have lower volatility to your portfolio, which is the point of today's discussion, it doesn't necessarily greenlight you to go ahead out and jack up, your account to take advantage of all that margin, right? Margin management is not risk management. So, for example, if you were trading one NYMEX crude contract and the margin hypothetically was $10,000, and by trading the Brent light sweet crude spread, the margin to hold that position, that spread position, would be, say, $2,000. Well, you don't divide 2,000 into 10 and come up with 5 spreads, because don't forget, when you're long one and short the other, they could both go against you. They typically don't, and I can't say that it's happened to me, but if you're long West Texas Intermediate and short the Brent, your short Brent can go up, and your long light sweet crude and NYMEX can go down, and you can lose on both sides. You can look at charts. There are patterns. There are breakouts. There are moving averages. You can look at consolidation. And there are very reliable seasonal tendencies that take place in spreads. Then I'll give you a few resources that you can get from both within your CQG platform, as well as looking at a research firm such as More Research, MRCI.com, where I don't have any conflicts to disclose, but a very good research in looking at spreads over the entire calendar year. Okay, so here we are. Intra-commodity spreads, as mentioned, oftentimes are referred to as old crop, new crop spreads. whereby you'll be long July and you can sell the December contract against that. Now, another one would be a famous trade known as the Widowmaker that you see there, the third one, long March natural gas and short the April. It's at a key time when kind of winter becomes the spring. What's going to happen with the natural gas? Are we still going to need to draw on stockpile, so to speak, or are we going to have to pump it back underneath the ground into the salt mines to store and leave it for electricity production and or maybe air conditioning come the summertime? That was the trade that put Amaranth out of business as well. Now, inter-commodity spread, here's an example that we'll look at that comes courtesy of my friends over at More Research. Long July 2012 soybeans and short July 2012 wheat. That is an inter-commodity spread because we're dealing with beans and wheat, two different commodities, albeit they're both grains. Another one you could look at that deals with protein content that cattle ranchers and feedlotters look at are the protein contents between Kansas City wheat and corn, Kansas City wheat and border trade wheat. Different grades, different protein content, different uses, but they have correlations, and sometimes those differences seasonally can get out of whack, in which case a spreader can kind of come in and put a trade on and capture that difference for financial gain. Here is a chart of the old crop, new crop spread in corn. You're looking at the July-December corn. As you can see, it's trading with what looks to be a credit balance. The way you look at this chart is that you're looking for the spread to widen, which means you want it to increase in value. So as it goes from, say, negative $1 to negative 80 cents to negative 60 cents, that number is becoming more positive as it gets closer to zero. So yes, on an absolute value basis, as the thing would sell off down to the lower right corner of the page, you are having a higher magnitude of an absolute value, but the way you look at spreads is you look at them and you own spreads that you want to widen or to increase in value. You would sell spreads that you would expect to narrow or decrease in value. Now, I want to say one caveat here. The language around spreads is very, very difficult from the standpoint of vernacular. The folks in Chicago use one language, and the folks in New York use a different set of vocabulary. And so to keep things very, very simple, I tend to stay away from using any of that jargon, whether you're buying the spread or selling the spread, because if you're like me and you're calling your trader on the phone, I tend to not enter things on the screen. If I say buy the old crop, new crop spread, I'm going to have to sit and dissect the thing anyway. So in order to avoid a lot of frustration, I tend to just speak it out loud and say I want to do one or the other, buy July, sell December at the market, or I want to buy July, sell December at a limit. As of course you know that the more qualifiers you add to an order, the less liquid you make it, so I tend to do these at the market. At the bottom of that chart you'll see the ATR. That's a 20-period ATR just for to gauge the volatility. And what's compelling here is if you looked at July wheat, December wheat as individual contracts, you might see a 20-period ATR of being upwards of 18 cents, which, as you know, is just under $1,000 in dollar volatility. And the whole point of this lecture is to show that you can trade the trend in these types of contracts, yet you can cut your volatility. And that 60 really means 6 cents. So you go from having, $1,000 volatility, and you're cutting that down by a whopping 66%. That's material. Why? Well, yeah, of course, I want to make money, and I'm not in this for 12%, right? That's what's good for pensions and endowments, but I'm here to make 100% plus a year. The point being is that if you are an allocator or you're seeking funds of funds or folks who you can hit up for money, in this day and age, they're going to be looking for your daily volatility. And if you have a daily vol that's over 50 basis points, they're going to look at you as being very, very risky. And if an outlier event hits, you might be called, to turn over your account. And they are not looking for that in this environment, not after what we've just been through. Case in point, when I started in the business, Tom Basso told me that you needed 2 years and about 20 million of assets under management, 2 years of a positive track record. Well, that's now like 3 years and 50 million, which of course is a gigantic, catch-22, i.e. 2 and 20, because if you have a 3-year track record and $50 million under management, you really don't need an allocation on some level to have a thriving business. You can kind of grow from word of mouth at that point. But as you look at this chart, you can see the spread is widening. It's reversed. There was a big range, a 40-cent range there at the bottom part, and then it's broken back out over the 80-cent level, and it's looking like it's going to trade to zero. If you look in the lowest right corner, you will see the letter or the month of May. And the reason that's there is because, and this is a caveat on risk management, the July is obviously off the board now. So you're looking at this year's July, December old crop, new crop spread that's no longer trading. The reason I ended it in May and I don't carry it out to the end of July is because, and this is a little inside baseball, as you know, the exchanges can expand margins. And one of the benefits of trading spread, like if you're trading July, December of 2012 spread, the limit moves for both are the same. But when the spot month or the front month becomes the spot month, limit moves can expand. And then so you lose that hedging capability because you have one month that can go twice the daily limit or expand worse to, you know, the back month, the deferred month as it's called, in this case to December, which would have, you know, your standard daily trading limits. So the one caveat to trading spreads is to make sure that as you're coming up to your July contract or whatever your front month is to becoming the spot month, you're going to look to either offset this thing or to roll it to a different group of months, say September, December, if you still think there's a relationship there. Another example is with these crude oils. There's a lot of talk about why is Brent trading at one level and why is the NYMEX crude trading at a different level. So let's take a look at what would happen, and we'll use it as an example on how you manage risk. Crude is one of those commodities that's problematic only because it's in the headlines every day. And my personal temperament is I don't like to trade the things that are going to show up in the headlines every day because all I need is some blogger to send something out and send the volatility to $3 right in my face. So I like to try to be below the radar. Nonetheless, that's my taste and preference. You're obviously going to do it the way it feels good for you. So let's just say, for example, your long NYMEX crude's worth 10 grand in terms of margin. If you put on the spread where you're long the NYMEX crude and you short the Brent crude, they're going to haircut it. It's not quite this much of a haircut there. I think it's about 35% if I look at the numbers. But just for illustrative purposes, you can see that you're getting a whopping, 75% haircut on the margin. Like I said before, though, that doesn't, or it should not give you a license to want to go out and trade 4 spreads. 4 times 2,500 obviously is the $10,000 bucks. But with that, you still have all the volatility there to attached. And one thing we're going to look at going forward is that your long contract can go down and your short can go up. It really hasn't happened to me in my career at all, but that doesn't mean it can't. So if you're going to look at a spread like this, yes, you're afforded a lot more breathing room, which helps you also if you're trading smaller accounts. So you get more bang for your buck in terms of being able to be in the trade, but you're also going to cut your vol, which helps you on performance. The thing to do wrong and to turn that upside down is to try to play Bruce Kovner now when he was a kid and trade too aggressively. In case you're not familiar with that story, let's take a look at the next slide and I'll go over it. Actually, let me go back. So you're looking at Bruce Kovner from Market Wizards. He was trading soybeans, and he was trading July-November, which is the old crop, new crop spread in the soybeans. What he found was that it was so volatile, it was trading like an outright contract. So what he was able to do was to take advantage of this margin math and jack up his account so that he was, turned, the number fantastically higher in his, in his equity in his account. And that's how he was doing it. Well, the FCM that he was dealing with caught on, and they said, no, we're going to have to raise your margin. And, of course, he was livid because he saw that as being a way to cut his alpha. He also made a mistake that I'm sure he'd never made since, which was lifting one of the legs off to kind of get cute as the market was moving in limits. We'll go over that going forward. It's one of the caveats of what you don't want to do when you trade these things. You want to put in the middle bullet there, if you're going to trade the spread, you put them both on at the same time. So concurrently, you write on your order ticket, you want to go long the WTI crude and short the Brent at the market at the same time. If you try to leg in, A, you're not going to have the spread margin as soon as you get filled on one of your legs, as they're called, but you're also going to be exposed directionally to a big sell-off if that's in fact the case. Here's the Widowmaker, the Amaranth trade that put Hunter out of business, and why he decided to put 65% of the firm's assets up against his margin for one trade is probably like a revenge trade, an ego-related trade, and the fact that John Arnold at Centaurus was on the other side of it is really no consolation because it was an idiot mistake. So likewise, you can see that there's a sell-off, there's a big range of consolidation of about 50 cents, and then it sells off to almost par. Again, the volatility is cut down to less than 3 cents. That's the 2.7 if you can make it out in the lower right corner. Now, again, this is an important part in the calendar because it's when the winter kind of goes towards the spring, and for folks who use the energy for heating-related seasonal tendencies, have to figure out, are we going to need more of it because the cold period of time extends into April, or are we going to have more favorable weather, meaning more warm weather, and not have the demand. So this spread is very reliable. Another one to look at is also October-December in the calendar year as well. Now, one of the ones that you can see is looking at an intercommodity spread. That's what the prefix inter means, between two different commodities. This is one that happens to be recommended by, again, Jerry Tepke and Melissa Moore over at MRCI.com. At the beginning of the month, they went long the July beans, short the July wheat of 2012. Obviously, neither of those contracts are going to be the spot month anytime soon, so you have perfect correlation between them in terms of what to expect. Let me just scroll down here, and we'll take a look at what has happened to this spread seasonally. Again, at the top of the lecture, I mentioned that you have decades and decades of seasonality built in that both farmers, users and producers of the commodities have dialed in and rely upon. So those things aren't going to turn on a dime. And here's what you see is a 15-year overlay is the blue line. The black line would represent where things were at the time I printed out this chart, which was probably a day or two ago. And then in the bottom segment, you can see both the 15 and the 5-year tendencies for the spread. So the spread does widen, and you can kind of count on that. There's a high degree of efficacy. More research provides this. You can get a 2-week free trial, and then there's a subscription basis to it. Again, I have any referral fees. I don't get any economic benefit. I will say that this is really good research. So you can see now how that spread has performed from an accuracy standpoint. With slide 13, we've been taught as commodity traders that if we can be right 40% of the time but have our winners exceed or overshadow our losers by, a factor of, say, 3 or 4 to 1, and that we can run our models with positive mathematical expectation. Well, here's a more rare example of where you can take longer-term trades and actually have positive expected value but also high accuracy. And again, I attribute that accuracy to the powerful fundamentals that are behind all these different types of trades that, a lot of newer traders don't like to look at or they can't look at because they don't know the fundamentals, right? It takes a lot longer, even for myself, to learn the fundamentals of even the cocoa market, for example, because it's a lot easier to look at a cup and saucer pattern or a Victor Sperandio, 2B reversal pattern, for example, on a chart. It's easier to do. So a lot of traders, focus their efforts on technicals and system building because it's easier. It's a lower economic rent, a lower hurdle to get into the business. So I give this to you to check out, and you can see if it makes sense for you. See, I think what's most important is to look at the rightmost column because those would be the drawdowns that you'd have to affect or that you would have affected in your account at any given time. So although the system is accurate and it made money, there's many, many years where you made money versus losing money if you put the position on and held it over the requisite time period, and it says that you enter on approximately whatever it is. I can't make out the date there, but you can hold it obviously for a couple of weeks. You did have to endure a drawdown of, in one case, $3,300, another one almost $2,500. So if you're running 100 grand in managed accounts, that's a 2.5 to whatever, over 3.5%, almost 3.5% drawdown just on a spread trade. So it doesn't mean that they can't be volatile, but they tend to be less volatile than the outright trades of the contracts themselves. And for those of you who trade cocoa, you know that there are no daily limit moves, and those things can really haul. In the case of the crudes, another intercommodity spread where you're looking at a trend in the front part of the trade, the trade narrowed, as it weakened, and then it consolidated for a while there, and now it's rallying, and it looks like the spread's going to widen. So you can trade this spread as well and be in the crude market and cut your volatility by a big number. Now, how does that trade work out? So for those of you who do have opinions, you know, you read The Economist, the Journal, maybe you're watching some TV to fill your head with various things. When you trade the spread the way you do, if WTI increases and the Brent decreases, well, then you're going to make money on both sides. As the spread's going to come in, the contracts will have more of an equal or closer to an equal value. That happened once in my career, and it was not in commodity futures. Back in '97, I was long Microsoft and short Netscape, at the time ticker NSCP, before AOL bought them. My thought being that it would be very difficult for Netscape to sell a premium web browser, although it was superior quality, when Microsoft had 90% of the desktop market. So that was a bit of an easier trade, although I don't really care for Microsoft products. My goal is to make money. So I can share with you that in 23 years, only once did I have both legs of the trade work out for me in the way the first bullet delineates here in this example. Another way is if you have WTI increases and so does Brent, but it doesn't increase by as big a margin. The third one is WTI goes up, Brent stays flat, it closes the gap. And the other two do the same thing. I'll spare you the details. The goal is that the spread's going to come in, it's going to narrow, and that's how you'd make your money. So it's a safer way to trade crude. Again, I don't do a lot of trading crude myself, truth be told, just because, again, it's very difficult. There's a lot of, obviously, the political confluence of religion in the Middle East is a big deal. And, again, I don't like waking up and having headlines. All you need is one of these countries to toss a nuke over the boundaries to another country, and, you know, the whole market's going to go berserk. So for my taste and preferences, I don't like to even think about those things. The only way you can cut that risk is to not trade it. So to structure the spread, going back to old crop, new crop, you go long the corn to July, the short to December. You can enter it at mark or a limit, but I would not. I typically enter and exit at market, only because, again, that's the most liquid way to do it, and when it's risk on, risk off. But you do both contracts concurrently. So when I go and call my trader and I say I want to do the spread, I want to buy the July and sell these at the same time. Sure, there's going to be a little slippage and skid, but the spreads are not like scalping, where you're trying to catch, you know, 5 ticks in natural gas, and, you know, you're fighting the high-frequency traders here. Because you have more time and a little bit more room, and you might be trying to catch, I don't know, $1 between the two, you know, crude contracts, or maybe a 30-cent move between, you know, the two corn contracts. In this case, you know, losing half a cent or 3/4 of a cent is not going to kill you by slippage and skid. Two, these markets are very, very liquid, so if you're trading 1s and 2s, probably up to 20s, you can get really, really good fills. It's not to say that the high-frequency guys aren't there. They are. Case in point, revisiting the last bullet there, the Kovner story from Market Wizards, don't leg in or leg off. If you think, like in the case of the soybeans back in the 70s from Market Wizards, the trader said, you know, the thing was going limit up, and it was likely going to be that way in the bean market for the next several days. So he took off the Novembers, which was the new crop, and sure enough, the thing went limit down in his face, whereby, you know, had he left the position alone, he would have been hedged, but instead now he had naked exposure. He gave back all the gains on the July, as well as being locked, you know, limit against. So it's an important lesson. It can happen to anybody. Don't leg on. In future things you can look at, you'll hear about crush and crack spreads. The crush spreads deal with soybeans, product spreads where you have the beans themselves, you crush them, and you get, you know, tofu basically, you know, soybean meal, as well as soybean oil. And the uses, you know, people, the soybean farmers and food processors look at this all the time, and they make sure that those relationships stay in place. There's a relationship between, you know, beans and bean meal. There's a relationship between beans and bean oil. And there's also a relationship between the two products. Now, there's a specific ratio that you look at with the beans and the crush spread. It's a little advanced. You know, maybe we could do it another time. You could follow up behind the scenes. I'll look at it for you. And same thing with the crack spread. You're looking at crude oil, you know, being refined into its, you know, two very, very common products that you can trade anyway in the commodity future space. And the NYMEX is heating oil and RBOB. so or about gasoline. So you basically have a ratio of how many crude oils do you need to refine it into heat and to gasoline, and those relationships can be traded as well. It's a little trickier because it's not one-to-one-to-one as the spreads we spoke about today are in both the intra and inter-commodity spreads. So you have to be a little bit more careful. It takes a little bit more confidence to get into it. I would not recommend them to you as a beginning spread trader. Also the yield curve. Kovner fell in love with the yield curve, I think was the quote from Market Wizards, and you can trade the steepening or the flattening of the yield curve by using financial futures, right, the interest rates. Obviously, you can trade stock market spreads. The thing is that with the market being a discounted mechanism, a lot of times you'll see like spreads with gold against gold, silver against silver, market against market. A lot of times you're just dealing with interest rates being the difference in the different months. And my take is if you want to look at interest rates or trade interest rates, just trade interest rates or financials as opposed to trying to use another product. I'm sure you have a few questions, and Betty, I'll toss it back to you. You can moderate, and I'm happy to answer, any questions that you have on inter or intra commodity spreads.
Thanks, Michael. That's great. Hopefully the audio is better and everyone can hear me now. So let's see. Let's get started. We have a question from Kelly. The question is, what tool do you use to determine when a spread is no longer trading in a range but has become a trending relationship like we saw in Kansas City, Chicago wheat earlier this year? Please answer this for both daily and especially intraday charts. Yeah,
I don't use intraday charts. It makes me crazy, so I can't really speak intelligently to intraday charts on spreads. I usually use end-of-day data for most of what I trade. As far as what tools that I use, I tend to not junk up my charts with lines and Keltner channels and otherwise and statistical bands or what have you. I look at the chart, again, after 23 years of trading, and I kind of have a feel for these. I do an enormous amount of reading, so unfortunately I don't have any kind of tool that you can overlay. You can certainly look at moving averages to confirm the direction of the trend. I look at reversals using the Sporandio 2B reversal, and more importantly, the Sporandio 1-2-3 trend reversal, which would show, a break first in the trend, then a consolidation period, and then a breakout either above resistance or below support to take the trend in a different direction. I try to keep it simple because if it gets too heavy, I end up doing something wrong and it ends up costing me money or costing me an opportunity.
All right, Michael, there's a question from John. I believe this was when you were talking about the soybean wheat spread, and he asked who's the seasonal data from?
So the exchange in calculating the margin, they have their own data. In terms of the data that MRCI uses, they have their own data as well that they get from the exchange, and they compile it, and they, Monte Carlo test the thing to see what would be the most efficacious way to get onto the spread, what dates to start, what data, lift it. And they have a whole spread calendar where they show you what would be the best days to enter spreads and when to exit them, if that answers your question.
Right, and as always, we record the presentation, and so that information will also be in there if they wanted to follow up on that. We have a question from Tim. What are some of your metrics you use to enter the spread trades? Moving averages, mean reversion, trend following, et cetera.
Again, you're looking at the seasonality. There comes a time in the calendar when this spread is going to take off one way or the other. And so you're really looking at the fundamentals. And you're waiting for the fundamentals to show you some kind of movement on the chart. A lot of folks forget when they're trading, I'm not saying that that's the case for Tim, but a lot of folks forget that in order for the charts to move, there has to be fundamentals happening behind the scenes, even if we're not aware of them or not, and I include myself in that conversation. There's only so much you can know. So I usually wait for evidence in the chart to see, like, is it trending one way or the other? I want to be a fast follower. But I also understand that, like I showed you, I think it was on slide, if you're still looking at the thing, slide number 15 here, if you can get two of these three correct over any period of time, it increases your odds of making money, whereas if you're long one of the contracts or short one of the contracts independently, i.e. trading it on a directional basis, there's only one way for you to make money when you're long, and that's for it to go up. If it goes sideways or, down, you lose. So I tend to look at these things as giving me more ways to win and more time for them to work out. And I look at the chart as to when to enter or exit the trade in terms of, establishing a position. And then I definitely add to the winners like any other good trader would do.
Excellent. Let's see what we've got here. A question from Howard. How do we pull up the spread chart on our respective trading platforms as opposed to just the single commodities?
Right. So, the syntax, I can shoot it over to Betty, and maybe she can share it with you. I think the function on your CQG is spread, S-P-R-E-A-D, open parenthetics, SN 12 minus, WN 12 close brackets, and that should give you the chart. If you look at, in fact, you can probably see it, although you'd have to increase the size. Let me just see if I can increase the size on mine. If you look at the top left corner, I think the guy's name was Howard. In slide 14, for example, in the top bar next to the CQG icon, it says spread, and there, in fact, you see the syntax of how to do it on your CQG, machine. It would be horrible bad form if I told you how to do it on another machine, given the nature of host is. So you'll have to figure that one out on your own.
All right, we appreciate that, Mike. Let's see, we've got a question from Jim. Do you only trade exchange-traded spreads, or do you trade synthetic?
Yeah, I see what you mean. Synthetic to me would be like using maybe options or using, I still think of synthetics as, a futures contract with an option, for example. If that's not the case, then your question's over my head. I typically try to keep it clean and not trade synthetics. I just do it exactly as the way I've laid it out here using futures contracts.
All right. We have a question from Rahul. Are there any resources on finding out the fundamental reasons the spreads move a certain way?
Yes, Rahul. Who I'm going to take a wicked guess is from California. There's plenty of free resources for you at MRCI that they allow you to just download or just grab off the net without having to give any identifying information. There's also a pretty good book that I like to recommend to folks that has a fairly strong complement of fundamental information, and that's the one by Tools and Jones, The Futures Game, Who Wins, Who Loses, and Why. It gets into the different things that you would need to know. There's also a free site out there that gives you a good amount of fundamental data as it hits the news, as it hits the tape, and that's agromoney.com. Again, I don't have any financial relationship or any conflicts to disclose. These are all publicly available, and you can use them and read them anonymously.
All right. We had a follow-up question from Kelly. On average, how long do you hold your spread positions? Do you day trade them?
I do not day trade. I don't have the temperament for it, and I see day trading as a way to not have a really high-quality life. I don't want to be in front of the screen at all. I don't care who the provider is, whether it's CQG or Bloomberg. That's just my temperament. When I was younger, I did. I don't day trade them. The holding period is 6 weeks or so, 3 weeks to 6 weeks. Every spread is different. Sometimes they only work out for a week, and sometimes they do take longer amounts of time over the crop year, for example, in the case of old crop, new crop spreads to work out. That said, sometimes the market can give you that very, very big gift. And if you're in a spread and all of a sudden you make 20, 30 cents, within a week or two, and that is that's not typical of how the spread's supposed to work, you can cut your risk, cut your position, or get out of it and wait for the spread to actually go against you and then add the thing back on. So you can trade it as an entity. Furthermore, although they're not entirely liquid, the CME does have options. Like you can buy a call option, for example, on the Widowmaker spread, which would be, you know, obviously a case where you could minimize your losses by being, you know, synthetically, again, via the derivative, have the same financial effect of owning March and being short the April natural gas contract in the form of option call premia. So I don't myself do it that way, but it is possible. My understanding is that those contracts aren't entirely liquid, and if they are, my guess is you're trading against John Arnold or floor folks who are the market makers, and you're probably, you know, at a disadvantage to trade them. So again, I'm a discretionary trader. I should say that as well, so that I make up my mind, you know, what's good. If I'm looking for an 80-cent move and I see 65 cents very, very quickly, I have to figure out, okay, what's the benefit for me holding on to the spread or having it in the portfolio? What am I holding on to that extra 15 cents for when I could always cut my risk? You know, my focus, even as a spread trader, a seasonal trader, largely is to always play the best defense possible. And spreads give me that buffer, but it doesn't mean that I'm off the hook.
All right. We have so many great questions today. I'm going to take a couple more, and then we're going to wrap. From Javier, do you set up stops on the spreads? Do you work these on the exchanges?
It's a great question. Usually if you give the orders, like with stops or limits, the broker will take them on a not-held basis, which means, you know, they're looking for a relationship. They're going to try to get it off as close as possible to where you want to get the thing off, but they also don't want to be held that if they miss it by 2 cents, you're going to come back and sue them. So if you are looking to work an order on a stop or on a limit and you put it in on the machine, you do make especially with a limit where it has to be a certain price or better, you make the order less liquid. My take on spreads and in all trading is that if you're trading directionals, you can put in stops and put them in and leave them in. But if you need to get in or get out of the market very quickly, do it on a market basis and just, you know, add the risk or take the risk off. I think that answers the question.
Excellent. And then one last question from Jim. It seems all the spreads you refer to are one-to-one. Do you consider weighted spreads based on regression analysis?
I don't do regression analysis myself, but I know the folks at the CME group do. And in fact, I've seen times where the spreads, such as the soybean wheat one, is actually modulated to have a 3-to-2 ratio. For simplicity's sake, I looked at it 1-to-1 here because it's easier to understand, but that is possible. I don't typically do the regression analysis myself. I have other folks doing it, but I guess they are doing it. Also, I tend to aggregate around a favored flavor. Like, you know, I don't typically trade too many spreads in the metals, in the stock market, stock index futures, or even in currencies on some level, and the crosses themselves can be looked at as spreads. I tend to stick with what I know, and that would be like in softs and grains for the most part. So it's a comfort zone for me. It's something that I know, and it becomes an area where I can have less unknowns work against me because they are out there. So that's just a personal preference.
All right. I want to thank everyone for the excellent Q&A session today. And I usually make this offer, Michael, so let me know if you're comfortable with it. But we will compile all the questions and get them to you. And if someone's question was not answered, hopefully you could get back to them on that.
Sure.
All right, and I just want to say, in case you didn't hear me at the beginning of the presentation today, you know, we're really thrilled to have Michael with us. He's the whole package. He's a trader, he's a writer, he's a teacher, and his book, The Inner Voice of Trading, just came out on Financial Times Press. And if you're interested in that, we did a podcast interview. I'd love for you to check that out as well. As always, today's webinar was recorded, and it will be available in a few days on our news site, news.cqg.com. And once again, Michael, I just want to thank you so much for joining us today.
Anytime, Betty. Thank you very much. You guys made it very easy to do, and I'd be happy to come back whenever you need me.
All right. Thanks again, and thanks all of you for joining us.
Okay.